So imagine you just poured, I don't know, millions of dollars into building this state-of-the-art fireworks manufacturing plant.
Right. Always a safe bet.
Yeah, exactly. And it's right on the coast of Florida, of course. So you have the permits, you have your staff hired, you're literally days away from opening your doors. And then your insurance broker calls with just terrible news.
Which is?
Every single standard insurance company in the state has just flat out refused to insure your building. I mean, they won't even touch it.
Yeah, they take one look and run.
Right. So what do you do? I mean, you can't legally operate without coverage. You certainly can't, satisfy your investors. So your business is just dead in the water before it even begins.
Well, unless you know how to access the alternative marketplace that exists specifically for situations exactly like this one.
Which is exactly our mission on this deep dive. We are exploring the framework of the Insurance Study Companion today, and we really want to demystify this concept that, honestly, it acts as the ultimate safety valve for the entire global economy.
It really does. It's called surplus lines insurance.
Yeah. And to understand how it saves businesses like our, hypothetical fireworks factory, we need to look at an analogy that perfectly frames the entire insurance industry. It's from the source text, and it's brilliant. So imagine the insurance landscape for a second as a town with two distinct hospitals.
Okay, I love this analogy. So Hospital A is the admitted market. This is where you go for routine, predictable care.
Like a broken arm or whatever.
Right, or you just have a common cold, you need a standard physical, you go here. In insurance terms, this is your standard homeowner's policy,
Sure.
or your everyday personal auto insurance, or just a basic commercial policy for a normal low-risk business, like a neighborhood bakery or something.
Something super boring.
Exactly. And the doctors at Hospital A, the underwriters, they know exactly how to treat you. The pricing is completely standardized, and all the paperwork is totally predictable.
It's a high volume, low complexity operation, basically. They have a strict playbook and they stick to it. But what happens if you walk into that hospital with like a completely unique, highly dangerous, or totally unstudied condition?
Yeah. Hospital A is going to take one look at you and say, we don't have the specialists for this. We don't have the protocols. We just can't take this case.
Because they're structurally incapable of handling the unknown, right? Like
Yeah.
their entire business model relies on standard procedures.
Right. If you don't fit the manual, you don't get the treatment.
So you need Hospital B. And Hospital B is the surplus lines market. They take the difficult cases, weird cases, the really high-risk ones. So today we're going to explore the mechanics of how this secondary market actually functions when the standard market says no.
And why everything's from, massive coastal resorts to emerging tech startups rely heavily on Hospital B just keeping its doors open.
Right. So let's start with the label itself, because the term we use for the coverage provided by Hospital B is excess and surplus, right? Or ENS.
Yes, ENS. And the formal definition in the study companion is that surplus lines insurance is coverage provided by non-admitted insurers for risks that standard admitted companies are, unwilling or unable to take.
Okay, wait, let me just pause you right there on that phrase. Non-admitted insurers.
I know where you're going with this.
Right, because when you hear non-admitted, the immediate reaction is just, well, suspicion. It sounds super sketchy.
It does. It sounds completely unauthorized.
Yeah, like if a doctor is non-admitted, you just assume they, I don't know, failed out of medical school or they're operating in some back alley clinic. It really implies something illegal, or at the very least, completely unregulated.
Which is probably the most common misconception in the entire industry.
Yeah.
And honestly, it is a major trap for anyone taking their CPCU exams right now.
Oh, really? Which exams?
Specifically CPCU 520, which is insurance operations, or 530 on business law. I love to test this. The term admitted has a very specific, highly technical legal meaning in the insurance world. It has absolutely nothing to do with legitimacy or financial stability.
Okay, so then what does admitted actually mean for Hospital A, like the standard guys?
So an admitted insurer is a company that is specifically licensed by a particular state's Department of Insurance. They operate under their standard, heavily regulated rules.
Okay.
The state acts as a very strict referee. They have to proactively approve every single rate the insurer charges. And they literally have to approve the exact wording of every single policy form used.
Wow, so down to the punctuation mark.
Literally, yes. The
Right.
state's goal there is total consumer protection and absolute uniformity.
So Hospital A has this really strict playbook dictated by state regulators. It's totally rigid.
Yes, so a non-admitted insurer then simply means a company that has chosen not to license themselves under that specific, rigid, rate and form filing system in that particular state.
Oh, interesting.
Right. But they are absolutely 100% legally eligible to do business there, and they are rigorously regulated for financial solvency. I mean, these are massive, highly capitalized financial institutions.
They just aren't using the state's exact forms.
Right, they just operate outside the state-approved standard rulebook.
That makes so much more sense. It's like they're playing a different version of the game that actually allows for flexibility. Because if you're a hospital B, you obviously can't use a standard state-approved treatment manual for a patient with a disease that was literally discovered yesterday.
Exactly. You need room to figure it out.
So the state basically allows these non-admitted insurers to operate legally so they can customize their approach. But, I mean, this brings up a massive question for me.
Okay, what is it?
If these companies are totally legal and financially sound, why is the standard market turning these risks away in the first place? Like, why are we forcing so many businesses to use this alternative E&S market?
Well, it comes down to the fundamental mechanism of how standard insurance actually works, which is the law of large numbers.
Okay, take me back to math class.
Right. Standard actuaries crave stability, They need millions of similar data points to predict future losses with pinpoint statistical accuracy. Like if a standard company insures, say, 10 million Honda Civics,
Right.
the individual crashes kind of just wash out in the statistical average. So they know with near certainty exactly how much money they are going to pay out in claims this year.
Right, because the math is basically bulletproof when the sample size is that massive.
Precisely. And that predictability is what allows them to file those standard rates with the state. But, as we know, the real world is messy, and innovation moves way faster than historical data.
Way faster.
Yeah. So the standard market will generally flee from risks that fall into four main categories: risks that are too new, too big, too dangerous, or too special.
Okay, which takes us right back to the examples we saw in the study guide. We mentioned the coastal fireworks factory, which is obviously too dangerous. But there's also the legal cannabis industry, which is too new and special, or like massive outdoor music festivals.
Or brand new drone delivery fleets. That's a huge one right now.
Yes. Think about a tech startup launching autonomous delivery drones. The technology is what, maybe 6 months old? There's zero historical data on autonomous drone crashes.
Right, so the law of large numbers completely breaks down. It just doesn't apply.
Because there are no numbers.
Exactly. A standard admitted insurer is going to look at that drone company and say, we have no statistical modeling for robotic airspace liability. We haven't filed a rate for this with the State Department of Insurance. And honestly, our standard commercial policy forms don't even have language addressing autonomous vehicles. So we have to decline this.
Wow. Leaving the drone startup completely stranded, because without insurance, you can't secure venture capital, you can't get bank loans.
You definitely can't legally operate in public airspace.
Right. So the business just dies on the whiteboard.
And that right there demonstrates the vital economic function of the surplus lines market. Because E&S underwriters are not bound by those state-filed rating manuals. They have the professional freedom to underwrite risks individually on a case-by-case basis.
So they can actually look at the specifics.
Yeah. An E&S underwriter can sit down with that drone startup, review their proprietary safety algorithms, assess the specific flight paths they plan to use, and literally do the complex math on the fly.
That's wild.
They build a customized policy from scratch, and they set a premium that accurately reflects the unknown risk.
So they are essentially providing the financial backstop for progress. Like without the E&S market, innovation would just stall out because no one in the standard market is willing to guarantee the financial risk of anything novel.
Right. So because of Hospital B, the drone company gets their customized policy, they secure their funding, and they launch. The entire economy moves forward.
Okay, but let's look at the actual logistics of getting through the door, because I know you can't just bypass the standard market because you want a flexible policy or whatever. The framework lays out a very strict sequence of events for placing business in the E&S market.
Oh yeah, you can't just walk right in. The golden rule of surplus lines is the diligent search requirement.
A diligent search. Okay.
Right. The standard admitted market must explicitly decline the risk first. In a lot of states, you actually need 3 formal rejections from admitted carriers before you're even allowed to look at the non-admitted market.
See, why create that bottleneck? If I know for a fact my drone company is way too weird for standard insurance, why do I have to waste time getting 3 rejection letters?
Because the state departments of insurance really want to protect the admitted market's premium base.
Oh, to keep the standard pool large.
Exactly. The standard market needs a massive pool of premiums to keep rates low for everyday consumers. If large, profitable commercial risks were allowed to just bypass the admitted market to go negotiate specialized deals in the E&S market, it would drain capital out of the standard system.
That makes total sense.
Yeah, so the state mandates that if a standard insurer can provide coverage under regulated rates, they basically have the right of first refusal. The surplus lines market has to remain a fallback, not a direct competitor.
Okay, so you go through the motions, you get your 3 rejection letters, now you're officially eligible for Hospital B. But I, as the business owner, I can't just call up a non-admitted underwriter and ask for a policy, right?
No, you definitely can't. You need a specialized guide because non-admitted insurers are not licensed to do standard retail business directly with consumers in that state.
Yeah.
So you have to use a licensed surplus lines broker.
Okay, so what does that broker actually do that a normal everyday insurance agent can't?
Well, a surplus lines broker holds a specific license that grants them the authority to place business with eligible non-admitted insurers. But honestly, more importantly, they hold the relationships.
The networking aspect.
Exactly. A standard retail agent might only know the underwriting appetites of, 3 or 4 standard carriers. But a surplus lines broker intimately knows the global E&S market. They know exactly which underwriter in London specializes in coastal windstorms and which one in Bermuda specializes in autonomous robotics.
Yeah.
They act as that crucial bridge connecting the retail agent and the consumer to the non-admitted capital.
Let's ground this with a real-world scenario from the companion guide. Let's look at commercial property specifically, a large luxury beachfront hotel in Florida.
Okay, perfect example.
So the exposure here isn't a new technology, it's Mother Nature. This place is sitting directly in the path of potential Category 5 hurricanes.
A textbook high-hazard property risk.
Right, so the hotel owner's retail agent goes to the standard admitted market, and 1, 2, 3 standard property carriers decline it. They basically say, we already insure way too many homes in that zip code. If a hurricane hits, our aggregation of risk is just too high. We can't add a massive hotel to our books.
Which is very common. So then the retail agent contacts a licensed surplus lines broker.
And that broker takes the hotel's data to the E&S market, finds a non-admitted insurer that specializes exclusively in catastrophic property risk, and boom, the hotel's insured.
The system works exactly as designed.
But, there is no free lunch in financial markets, right?
No, never.
If this non-admitted insurer is stepping up to take on a massive hurricane exposure that terrified the standard market, they aren't doing it as a charity. The risk is immense. So what is the actual catch here? What's the cost to the hotel owner for accessing this alternative market?
Yeah, that's the big question. There are 3 major trade-offs a consumer faces when they enter the E&S market. The first one, as you probably deduced, is price.
I figured.
Yeah, premiums in the surplus lines market are almost always higher, sometimes exponentially so. And because they aren't restricted by those state-approved rate tables we talked about, that price is individually negotiated based heavily on the specific loss history and the exact nature of the hazard.
So you're basically paying a premium just for the sheer privilege of securing capacity when the standard market has closed its doors.
Exactly. You pay whatever the market dictates because your alternative is literally zero coverage.
Ouch. Okay, what's the second trade-off?
The policy wording itself. In the admitted market, policies are heavily standardized. If you look at a standard commercial property form from Carrier A, it looks practically identical to the form from Carrier B.
Right, because the state ensures that uniformity?
Yes, but in the E&S market, policy forms are highly customized. The underwriter might insert strict warranties. For instance, they might require the hotel to install specific super expensive hurricane shutters before coverage even applies.
Oh, wow.
Or they might exclude certain types of water damage entirely. So the consumer and their broker have to really scrutinize the fine print because standard protections are just not guaranteed.
Wow, okay. Which brings us to the third trade-off, and this one seems like the most critical piece of the entire puzzle, especially for professionals studying the mechanics of the industry.
Yes, the big one.
What happens if the absolute worst-case scenario unfolds? Like, a massive hurricane wipes out the hotel, along with half the Florida coastline. The non-admitted insurer is hit with billions in claims, and they just go completely bankrupt. What happens to our hotel owner?
This is the ultimate danger, and it introduces a very vital concept: the state guarantee fund.
Okay, what is that?
When an admitted standard insurer goes bankrupt, the policyholders are protected by this fund. It functions kind of similarly to how the FDIC protects your bank account if your bank fails.
Ah, okay.
All the other admitted insurers in the state pay into a pool, and the state uses that pool to pay the outstanding claims of the insolvent company. It's a massive safety net for the consumer.
So if Hospital A goes bankrupt, the state steps in and makes sure your medical bills are still covered?
Exactly. But, and this is a fundamental rule of the industry, if a non-admitted surplus lines insurer becomes insolvent, the policyholder is generally not protected by the state's guarantee fund.
Wait, really? So if Hospital B collapses, you are completely on your own?
You are left holding a totally uncollectible claim.
That is terrifying.
It is. But the logic from the state's perspective is straightforward. They basically say, look, we did not approve this company's rates, we did not approve their policy forms, and they do not pay in to our guarantee fund pool. Therefore, we will not bail out their policyholders.
I mean, it makes sense, but wow, that is a staggering trade-off for the business owner.
It's the ultimate risk of stepping outside the admitted market.
I mean, the E&S carriers are financially regulated and generally very well capitalized, but that final state-backed safety net simply does not exist.
Right. And this explains why it is such a heavy focus for industry professionals. In fact, if you're studying for your CPCU designation, the framework explicitly highlights a typical exam question you need to master based on this exact dynamic.
Okay, let's hear it. For anyone taking the test.
The question usually reads something like, which type of insurer should write a risk that admitted insurers refuse to cover?
And the definitive answer is?
An eligible surplus lines insurer. Because even though they lack that guarantee fund protection, they are legally eligible to step in when the standard market declines the risk.
Got it. And, understanding when the standard market declines risks leads us into the macroeconomic side of this deep dive. Because the size of the surplus lines market isn't static, right? It expands and contracts based on broader economic forces.
Oh, absolutely.
Specifically, something the study guide calls the hard market.
Yes. The insurance market operates in cycles. It primarily shifts between a soft market and a hard market. During a soft market, capital is abundant.
Life is good.
Life is good. Insurers are making strong returns on their investments, so they are eager to write more policies to get more premium dollars to invest. Underwriting standards loosen up, prices drop, and the admitted market is willing to take on much more complex risks.
So the E&S market actually shrinks because standard carriers are just swallowing up all the business.
Precisely. But obviously the economy doesn't stay sunny forever.
No, it definitely doesn't.
When inflation spikes, or there's a string of severe natural disasters or the stock market plummets, insurers' capital reserves take a massive hit. And this triggers a hard market.
Because their capital shrinks, which means their capacity to take on risk shrinks.
Exactly. Standard insurers panic. They dramatically tighten their underwriting guidelines. They raise prices across the board. They even stop writing certain classes of business entirely. They might look at a portfolio of perfectly normal middle-market apartment buildings and just say, we are overexposed, cancel all these policies.
Wow. So Hospital A suddenly puts a sign on the door saying, we are only accepting patients with minor scrapes. Everyone else, go away.
Right.
But those apartment buildings still need insurance.
Which means all of those relatively normal risks get shoved aggressively into the surplus lines market.
Oh, wow. So in a hard market, the E&S sector just explodes with demand.
It does. They have the pricing flexibility to charge the really high premiums required to justify taking on the risks that the admitted market is currently just too undercapitalized to handle.
Okay, but that requires an astronomical amount of capital in the E&S market, right? To absorb that sudden influx of normal business on top of all the usual weird risks.
Massive amounts of capital.
So where does all that money come from? Because the framework mentions a very famous name when discussing surplus lines capacity. Lloyd's of London.
Yes. When most people hear Lloyd's of London, they tend to think of publicity stunts,
Like insuring a famous rock star's vocal cord.
Exactly. Or a food critic's taste buds.
Right, the ultimate bizarre Hospital B cases.
But on a macroeconomic level, Lloyd's is actually one of the most critical engines of the global E&S market. And it's really vital to understand that Lloyd's of London is not an insurance company.
Wait, it's not?
No, it is a marketplace. It operates much more like a stock exchange for risk.
Huh. How did that actually work mechanically then?
Instead of one massive corporation taking on the risk, Lloyd's is made up of syndicates. And these syndicates are backed by massive amounts of capital from corporations, investment funds, and individuals worldwide.
Oh, I see.
So when our surplus lines broker from earlier needs to insure that billion-dollar coastal resort, they might take that risk to the floor at Lloyd's. One syndicate might agree to take, say, 10% of the risk.
Okay.
Another syndicate takes 15%. They pool this global capital together, piece by piece, to build enough capacity to insure risks that are simply too large for any single standard admitted carrier to stomach.
That is fascinating. They are basically crowdsourcing capital for massive exposure.
Yes, that's a perfect way to put it.
That makes perfect sense.
Uh,
They have the flexibility and the pooled capital to act as the ultimate shock absorber for the global economy during a hard market.
Exactly.
And to lock all these mechanics into place, the framework provides a very simple, catchy memory formula.
Yeah.
If you want to crystallize the fundamental divide in the industry, just remember this. Standard risk goes to the admitted market. Special risk goes to the surplus lines market.
It is the perfect distillation. Admitted insurers handle the standard, regulated, predictable world. Surplus lines insurers handle the unique, high-hazard, customized world.
Awesome. Well, let's summarize the mission we set out on today. We wanted to demystify surplus lines, or E&S insurance. And far from being sketchy or unauthorized, these eligible non-admitted insurers are the crucial safety valve for innovation and high-risk enterprise.
Absolutely vital.
Right. The standard admitted market handles your everyday autos and standard commercial risks using state-approved rates and backed by the safety net of the State Guarantee Fund. They rely heavily on the law of large numbers to ensure predictable outcomes.
But when that predictability vanishes, whether it's an untested drone startup or a coastal fireworks factory, or even a sudden hard market shrinking standard capacity, the surplus lines market steps in.
Yeah, they negotiate prices individually, they construct highly customized policies, and they deploy massive pools of specialized capital to keep these businesses operating. Even without the guarantee fund safety net, they just do the hard math on the fly when the standard rulebook fails.
They do.
So as we wrap up this deep dive, what is the core insight you want everyone listening to take away? Like something to rethink how they view the secondary market.
I want to focus on the timeline of innovation. We discussed emerging risks, specifically things like cyber liability and complex artificial intelligence.
Right, the stuff that's evolving daily.
Right. The standard admitted market requires years, often decades, of robust historical data to comfortably price a policy and get it approved by state regulators. But the modern world innovates in months, not decades.
Very true.
So because the E&S market has the freedom to underwrite without historical data, they are always the first ones writing policies for the unknown.
They are kind of forced to be the pioneers.
They are. Which raises a really interesting perspective. The surplus lines market isn't just a safety valve for bad risks. It is effectively the secret research and development department for the entire insurance industry.
Oh, wow. R&D.
Think about it. When cyber threats first emerged, E&S syndicates figured out how to insure them. Decades later, once the data finally stabilized, those policies migrated into the standard admitted market.
That is brilliant.
So if you want to see exactly what standard everyday insurance is going to look like 20 years from now, you shouldn't look at the admitted market. You should be closely analyzing what the E&S market is underwriting today.
Key R&D department of the global economy. I mean, I had never framed it that way, but it completely redefines the value of the non-admitted market.
It changes the whole picture.
It really does. So the next time you see a standard hospital turning away an impossible case, just remember that the real medical breakthroughs, the protocols of tomorrow, are being written right now over at Hospital B. Thank you so much for joining us on this deep dive. Keep examining the unseen mechanisms that keep the world moving, and we will catch you on the next one.